Hello, everyone. Thank you for joining today's COVID-19, the new normal for the alternative investment industry webinar. Today's program will be presented by Joseph Cassano, Daniel Mayo, Ralph Natilli, and Michael Oates. Before we begin, I have a few housekeeping notes. Just a friendly note, this webinar will not be covering the SBA loans. Withum will be hosting a separate webinar tomorrow from 12 to 2 on SBA loans and financial assistance. To register, visit our COVID Resource Center on Withum's website. At the bottom of the toolbar, you will see a question box. Please type in your questions during the presentation. All questions pertaining to the webinar content will be answered tomorrow during our live Q&A at 10:30. If you're interested in attending, please register under the Events tab on the Withum website or email me directly at datkinson@withum.com. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant content going forward. With that, I'm going to turn it over to Ralph.
Thank you, Danielle, and welcome everybody. I hope you and your families are all staying safe and healthy. I'd like to start out with a quick regulatory update. So the SEC has given relief regarding the custody rule, granting a 45-day extension to the 120-day financial statement delivery requirement. And this covers registered investment advisors, and it covers BDCs as well. But if relying on the relief, the registrant must notify the SEC before the original due date, which was April 29th, and give reason for the relief. I think the reason would be obvious. They also recommend documentation in writing from the auditor, because we're obviously the coronavirus experts, and to notifying clients and investors either directly or through website that the financial statements will not be available within the 120 days. The Division of Enforcement will not recommend any action for a violation of the custody rules against any advisor that's relying on the rule that reasonably believe that their audited financial statements would have been distributed within the 120-day period, but failed to due to unforeseen circumstances. Relief's already also been given a 45-day relief for certain 13F and 13G filings. Most recently, relief's also been given to Forms ADV and Forms PF, if registrants have been affected, of course. They will also need to provide reasons why relief is needed. 13D filings have not been granted any relief. Those remain due within 10 days of the transaction. As for broker-dealers, focus filings due between February and April are being granted a 10 business day extension. Annual audits are being given a 30 calendar day extension for filing financial statements for broker-dealers with year endings between January and March. This, of course, could be further extended if the pandemic lasts past April. As to periodic exams of registered investment advisors, this will be business as usual. Since most exams are done remotely, they're not going to be stopped as of yet. Now let's take a look at what's going on in the Cayman Islands. Since the major deadline, the next deadline for filing financial statements and related FAR forms is June 30th, there has not yet been any notice of an extension of time, but we will continue to monitor news from the Cayman Islands Monetary Authority over the coming months. And one item of note is that SEMA has decided to update the current FAR form, and it's going to include more informational data about funds and investors. We'll have to wait and see what that information is when the authority posts its new form to its website. But if you're ready to file financial statements now, you can still use the current form to file with SEMA, and it'll be considered timely filed. Now, as a reminder, the new mutual funds law in the Caymans now require all private funds, including closed-end funds, to be registered with the authority and subject to SEMA regulations. This includes filing of annual audits with SEMA and the related FAR forms, and those audits have to be performed by a SEMA-approved local auditor. Mutual funds with 15 or less investors that were previously exempt from registration are now also required to be registered. Now, August 7th, 2020 is the date the registration must be complete. There is discussion to extend this under the current circumstances, so we'll wait and see what happens there. Finally, I'd like to say, given that today's technology and that everyone's working remotely, I personally have yet to see any significant delays in obtaining information from fund managers and administrators. And I think that our audit work has gone on seamlessly so far. So I would expect and certainly hope that most managers would not need to make use of the relief we've discussed. Now I'd like to just turn it over to Joe Cassano to discuss asset valuations and other fund management considerations. Joseph?
Thanks, Ralph. Some effects on fair value and things to consider. Advisors should consider factors that determine whether there is a significant decrease in volume and level of activity of an investment when as compared to normal market activity. A few examples are there are fewer transactions, price quotes are not based on current market information, price quotes vary substantially either over time or among market makers, indexes that were previously highly correlated with fair values are demonstrating uncorrelated indications on fair value, and there are large spreads between bid-ask prices. If volume levels decrease, further analysis should be done on transactions or quoted prices, as they may need to be adjusted to estimate fair value. For example, when a price for a similar asset requires significant adjustment to make it more comparable to an asset being measured, or when a price is stale, you want to consider if a transaction is orderly and is not a fire sale. For instance, consider if a transaction was made at a discount to adhere to an investor redemption, or compare transactions to other market quotes, and if the conclusion is the transaction is not orderly, the advisor should place little reliance on the transaction. Advisors should consider now more than ever, with the market volatility, engaging an independent valuation firm for level 2 and level 3 investment. Advisors should also consider their business continuity plan. In these unprecedented times, this forces advisors to ensure their plan is working properly and is a seamless transition. Things to remember are, as it seems everyone is working remotely, we're seeing an increase in hackers seeking to circumvent cybersecurity by targeting smartphones. Don't click on links unless you know the source, and even if you know the source, it makes sense to place a call to ensure the link is real. Advisors should be reviewing their verification and their login remote procedures now that most employees are working remotely. As we navigate these uncharted waters together, communication and transparency with investors and service providers is key. Let everyone know it's business as usual. Things we have seen come up are investor inquiries on key man and overall health of principles. Make sure everyone internally is communicating and on the same page. You don't want to be communicating on the fly with regards to health questions, since we don't know and will not know for some time ultimately who will be affected by the virus. To combat this, we have seen some advisors doing weekly update calls. To date, we have not seen high levels of redemptions like we did in 2008. On the contrary, some investors might be looking at this as an opportunity at a depressed market. If advisors are taking in new capital in April, advisors should show their market performance numbers, and open-ended funds should consider side pocketing level 2 and level 3 investments where there is not a readily accessible market or if there's uncertainty on the valuation, so new investors are not exposed. Most advisors updated their documents after 2008, but if they did not, they should consider reviewing documents for dates on redemptions to prevent a run on the fund. As certain assets may become less liquid in various markets, advisors should review the governing documents to understand the options they need to consider in the event of redemption. In addition, advisors should be speaking with their outside accounting and valuation firms to determine appropriate valuation protocols, particularly if liquid assets suddenly become less liquid. I'll now hand it back to Ralph, who's going to discuss some additional financial statement disclosures.
Thanks, Joe. So what does this mean for financial statements? As Joe said, it means additional disclosures. First off, a pandemic risk factor can be shown as a risk in the financial statements, but if adding, should make specific mention of mention the specific risk factors involved here, and such as geography risks like Asia, Europe, etc., and particularly industry risks for those sectors that have been hit hard by the crisis. You know those, transportation, hospitality, and the like. Now, as auditors, we typically look at activity after December 31st that may require disclosure as a subsequent event. In particular, this year, we're looking for significant declines in NAV. If this has occurred, managers may need to consider disclosing what first quarter 2020 performance was. In addition, we're also looking at redemptions, specifically those that are being requested that may be effective not until the end of the first or second quarters. In this case, ultimate amounts are not known as the capital is still in play until the end of the quarters. But if material to December 31st NAV, these amounts need to be disclosed as well as the timing. What I like to see is a percentage of the December NAV that is being requested to be withdrawn. Lastly, the SEC and the PCAOB have both recommended, and when they say recommend, they usually mean require, that management discuss COVID-19 in the financial statements and its particular effect on the industry and asset valuations or fund performance. Noting while the ultimate outcome is certainly going to be uncertain at this point, they need to disclose that there could be a possible effect that is adverse on NAV, fund performance, and at worst case, the ultimate survival of the fund. Now, before we move to our tax compensation, I'd just like to note that if there's any silver lining in this current crisis, it's that we're still seeing an uptick in new fund launch discussions and capital raising by both emerging managers and established funds. Established funds are looking to take, and emerging managers looking to take advantage of the depressed market, which is very attractive if there's buying power. Funds that have seen significant losses in 2020 are sticking to the plan, even looking to take on new capital and ultimately invest in the market rebound. And if history has told us anything, this market's going to rebound. I guess the only big question remains is not if, but when we're going to see that market rebound. Now I'm going to turn it over to our tax discussion and Mr. Michael Oates.
Thank you, Ralph. There are a few tax provisions that impact the alternative investment industry in the CARES Act. Both myself and Dan Mayo will touch on a number of the more relevant tax issues associated with it. So the CARES Act repealed the excess business loss limitation under 461L for years prior to January 2021. These provisions only applied from 2018 to 2025, so 3 of the 7 years now have been eliminated. This is retroactive, so it could impact 2018 returns with limitations of business losses of over $250 for a single filer or $500 for a filer married filing jointly. So we may need to amend 2018 returns for refunds or possible NOLs. We did have a number of, general partners of management companies who had limitations on their 2018 returns. So we'll have to look at that for amendment purposes over the next couple months. The acts also included several technical corrections to section 461L for future calculations. So the section calculates, now excludes items attributable to trade or business of performing services as an employee. This was one of the areas that wasn't very clear in the past. In addition, net operating losses and qualified business income deductions under section 199A are not taken into account. Further, deductions from losses from the sale or exchange of capital assets are not taken into account in increasing a section 461L limitation. And then certain gains from sale or exchange of capital assets may continue to be taken into account in reducing a potential 461 limitation. But since gains first need to be offset by losses, that inclusion may not be reduced as much as it would on a gross basis. Net operating losses generated in 2018, 19, and 20 will be permitted to offset 100% of income in taxable years 2018, 19, and 20. This relaxes restrictions introduced under the 2017 Tax Cuts and Jobs Act, which both precluded NOLs generated after 2017 taxable years from offsetting more than 80% of income in any subsequent years and prohibited the carryback of NOLs. There is a new 5-year NOL carryback rule. Any NOLs generated in 2018, 19, and 20 may now be carried back to the 5 preceding years, allowing for refunds of any taxes paid in those previous years. This would serve to temporarily lift the TCJA's elimination of the carryback of NOLs generated after 2017. Note that for corporations, NOLs carried back to pre-2018 taxable years where the rate was 35% is much more valuable than offsetting income currently at a 21% rate. A REIT is precluded from carryback losses under the CARES Act. The legislation also restricts loss carrybacks from being used to offset deemed repatriation income that was includable to a corporation as a result of the TCJA. The Act also updates the calculation of business interest expense limitations under 163J, which could impact trader funds using debt financing. The first part of the test remains the same. So to the extent business interest expense exceeds business interest income, the business interest would then be permitted to offset up to 50% of adjusted taxable income, ATI, in 2019 and 2020, as opposed to a 30% limitation imposed by the TCJA. Currently, ATI is calculated in a manner similar to EBITDA, except subject to a couple modifications. In addition, the CARES Act allows taxpayers to elect to use 2019 ATI for purposes of its 163J limitation for 2020, which will potentially benefit taxpayers that will have lower projected ATI for 2020 due to the impact of COVID-19. This favorable 50% limitation is only available to partnerships in 2020. For 2019, however, excess business interest of a partnership is allocated to the partner and then is bifurcated. 50% of the excess business interest becomes fully deductible in 2020 taxable year, and 50% remains subject to the limitations of present law. Therefore, the remaining interest would not be deductible until the partnership allocates additional excess taxable income or excess interest income to the partner. Private equity funds will need to analyze potential benefits of CARES Act as it relates to 163J to ensure that they are maximizing potential benefits for their funds and also various portfolio companies. In addition, consideration should be given as to whether the put in place short-term financing that can benefit from the temporary increased deduction limitations afforded by the CARES Act. Dan, I'd like to turn it over to you to see if some more of the tax provisions under the CARES Act.
Okay, thanks, Mike. So we're going to talk first about an extension that was granted for corporations and individuals, and then we'll get into some CARES Act provisions and then some general employee benefit provisions that might be of interest to the group. So first, the IRS granted an extension for individuals and corporations, mostly with returns due April 15th, 2020. It's an automatic 3-month extension. No form is required to be filed. It applies to 2019 income taxes and 2020 estimated income taxes. It also applies to a partnership or other entity that has a return that happened to be due April 15th, which wouldn't be very common. It applies to gift tax returns that were due and generation skipping payments that are due on April 15th. It applies on the foundation, private foundation side. It does not apply to the 990 PF, but it does apply to the 990 T for tax exempts, that if that return is due April 15th, and it does not apply generally to the 990, which is generally an information return. It only applies to tax returns. So it is a filing and payment extension, again, from April 15th to July 15th. No extension is required to be filed. So that's a favorable development that was announced a couple weeks ago and subsequently modified a few times, by the way. It keeps changing and expanding as time goes on. So the next thing we'll do is talk about some provisions now of the CARES Act, which I think will be useful to the group. Two in particular, the employee retention credit and employee payroll tax deferral. And both of these, I want to point out, are only available if a taxpayer does not take advantage of the Paycheck Protection Program loan, which is that forgivable loan program for businesses with under 500 employees. And so that's a significant roadblock right there. So it's path dependent. So either you take these two credits or you go for the PPP route. And we found that many, if not most of our clients are going the PPP route. The break point seems to be, if compensation exceeds the 30 grand range for most employees, you're likely going to benefit more from the PPP forgivable loan. But if you do take the route of the employee retention credit and the payroll tax deferral, it probably makes sense. You would layer these on with each other, and then you would also layer in the EIDL loan, the Economic Injury Disaster Loan, which you obtain by applying to the SBA. And also the SBA will give a grant, a one-time grant of up to 10, which is not a loan, but a one-time grant up to $10,000 within 3 days of applying for the loan, that EIDL loan. And that grant is transferred right to the taxpayer's bank account through the ACH system. So what is the employer retention credit? It is a refundable payroll tax credit for 50% of qualified wages that are paid from March 13th to the end of the year. And so in terms of guidance, the IRS has put out some frequently asked questions. They gave out with an information release, and also a form to claim these credits, a new form that they issued draft one day, I think on the 30th of March, and then finalized the next day. So that's Form 7200. So what are the qualified wages then? So it's really designed to impact employers who were significantly affected by the COVID-19 crisis. So there's two ways to get into the credit. One is your operations were fully or partially suspended due to a COVID-19 related shutdown order. So here I would think of, full suspension, meaning some non-essential retail stores. Partial suspension probably applies to the restaurant industry and similar businesses where they, can provide takeout and delivery, but not in restaurant dining. So the second test is not based on the suspension, but it's a gross receipts decline test. So if your gross receipts have declined by more than 50% when compared to the same quarter in the prior year, then the employer can take these payroll credits. And the period they can take the credits goes from, it starts in the quarter in which receipts decline by more than 50%. It ends in the quarter when your receipts have recovered, so the decline is less than 20% from the same quarter the prior year. And so this credit's available for any size business, regardless of the number of employees. Although it's more generous for companies with 100 or fewer employees because of the way they define wages. So if a company has more than 100 full-time employees, it only applies to the wages of someone who's not working. So they're employed but not working because of the shutdown order, for example. If you have 100 or fewer employees, it applies to all wages for all employees. The credit is capped at the first 10,000 of wages, and because it's a 50% credit, that means there's a maximum credit of 5,000 per employee, and that's the number I'm using to say the 30,000 breakpoint. And that is a rough sort of back of the envelope calculation. There are other factors, but that's a rough guide. The credit's not available, as I mentioned, if the taxpayer takes a covered loan under the PPP, which is a forgivable loan program. And as I said, the IRS has issued guidance on the way this credit is refunded is that the taxpayer stops depositing some of their employment taxes. They reduce their employment tax and income tax deposits to the IRS, and that's how they recover the costs of these the 50% of the payroll. And so in the event that the payroll exceeds that, it's a refundable credit. They can apply on that Form 7200 and get a refund. The next thing, so that's the employer retention credit. The next is this employer payroll tax deferral, and this is another great thing. Unfortunately, you can't do this and the PPP as well, because once you have, the way it's worded actually, it doesn't just say you have to obtain a loan under the PPP. It talks about forgiveness of a loan under the PPP, but the only reason you'd go for not the only, but 99.9% of people obtaining loans under the PPP are planning on forgiveness, and they're actively planning for that before they even apply for the loan. So it's likely if once you take the PPP, you're forgiveness is all but certain, some amount of forgiveness. And once that happens, you can't take this holiday. So what is this holiday though? The holiday says employers can defer their employer's share of Social Security tax of up to 6.2%. It also applies to self-employment taxes at a 50% level, but it covers taxes due from March 27th, when the CARES Act was passed, up until the end of the year. And what it says is the employer can not deposit these taxes with the IRS, and they can defer it so that the total amount deferred must be paid in equal installments by the end of 21 and the end of 22. So it's half of it's deferred for 1 year, half deferred for 2 years. The interesting thing about this, it applies regardless of the size of the business, the number of employees. There's no limitation there. And the statute also doesn't impose an interest charge. So it really is an interest-free loan. And it's hard to see why someone wouldn't take advantage of it if they could. Again, the big roadblock here being that you can't have any debt forgiveness under a Paycheck Protection Program loan. One side issue we'll point out, and I don't think it's going to be a deterrence, just a consequence. If an amount is deferred under this arrangement, the deduction will also be deferred that one would take for the deduction for their share of these taxes. So the deduction would be deferred until the tax was paid. So that's those are the two things I wanted to highlight under the CARES Act, and then I want to discuss two other brief sort of employee benefit programs and assistance programs that companies offer their employees. One is just employer loans. We know employees have taken a hard hit during this pandemic, and so employers are thinking about loaning funds to their employees on a temporary basis. They can decide at a later point if they want to forgive some or all of it, and it's a separate discussion on the taxation of forgiven loans. But just the loan itself could give rise to a taxable event. So consider not the current situation, obviously, but consider a 5% interest rate market. And so if the company gives a zero interest loan to its employee at a time when the prevailing interest rate is 5% for a similar loan, there is a compensatory element to that loan to the extent of the present value of the current loan, 0%, versus the present value of a loan at 5% interest. So that difference in value would be compensation to the employee, imputed income to the employee, and the employer would also get a deduction. So how do you get around this? And so there's two ways around it. One, there's an exception in 7872 for aggregate loans of 10,000 or less. So if the employer's thinking of loaning, 11,000, 15,000 at a zero rate, and they're concerned about this issue, they could just reduce that to 10,000 and not worry about whether there's a compensatory element to the loan. Also, and this is, I think, the more relevant point that's more likely to affect decisions. The rate is so low. The rates are so low these days that I looked up the rate there's a special rate in the applicable federal rate that applies to loans under this section. And the minimum rate that must be charged for a 5-year term loan is 1%. So it really is very low. It's hard to see a large compensatory element to these loans. Even a zero interest rate loan for 5 years, the compensatory element is just the difference between 1% and 0. So if you wanted to avoid it completely, though, 5-year loan, it's around 1%. It's not exactly, I think it's 0.99 or something. And new rates come out every month, so this changes. But I wanted to give you a sense of what the current rate is so you could plan around it. The last thing I'll mention today is Section 139. And this is a great arrangement for a company to provide assistance to an employee for the reasonable and necessary personal, family, living, and funeral expenses that they may incur as a result of a qualified disaster, which again includes COVID-19. If this section applies, and it's a great benefit because it sort of provides what I jokingly refer to as a holy grail of tax planning, which is the employer makes a payment to an employee, the employer gets a deduction, and the employee has no inclusion. So you have this deduction non-inclusion scenario, which is, again, the holy grail of tax planning. So let's talk about what's covered, what's not covered. What is covered are medical and funeral expenses of the family as a result of COVID-19, child care for workers whose normal source is unavailable. I realize in this day and age, that's hard to find in any event, given that few people want to admit strangers in their house. Also, it covers telecommuting costs, printer, office supplies, increased utility costs as a result of COVID-19. So if a company wants to provide these, it can provide on a tax-free basis these types of expenses for their employees. What's not reimbursed are items that are covered through insurance or some other contractual arrangement. General income replacement payments like sick pay or lost wages would not be covered. And then finally, non-essential luxury or decorative items would not be covered. So really trying to get at the reasonable and necessary personal, family, living, or funeral expenses of an employee. We recommend that companies have a written plan in place if they're going to administer these programs, and that's mostly to ensure that the employees understand the scope of the program, that it's administered fairly, have the claim submission process, et cetera. But the one key point is it doesn't have to be an accountable type plan. If anyone's familiar with general employment reimbursement programs, the taxpayer is not required, the employee is not required to account to their employer for the expenses, provided it's a reasonable amount for the type of expense occurred, so that the employer gives an amount to the employee and it reasonably covers the items they're expecting it to cover. The employee doesn't have to come back with expenses, is not required to justify what they spent it on. And so this is a great way to provide a benefit to employees, which will hopefully come back multifold to the employer in terms of goodwill and having happy employees. So that's all I had on my list to cover. Mike, Joe, Ralph, anyone else?
Yeah.
Thank you everyone for attending today's webinar. Please remember to take a moment to complete the online survey. Thank you and have a great day.